Have you ever felt completely overwhelmed and lost when trying to understand the complex world of cryptocurrency and its intersection with something as daunting as tax law? You're not alone. The digital asset landscape is evolving at a breakneck pace, and with it, the rules and regulations that govern how we interact with it. From Bitcoin to Ethereum and everything in between, the potential for wealth creation is undeniable. But as the old saying goes, with great power comes great responsibility, and in this case, that responsibility is understanding your tax obligations. Today, we're diving deep into a topic that's on the minds of many Canadians, the relationship between the crypto platform Gemini and the Canadian tax system. We're not just going to talk about what Gemini is, we're going to break down the specific ways your activity on the platform is viewed by the Canada Revenue Agency, or the CRA. We'll explore everything from basic transactions to more advanced strategies like staking and lending, and we'll arm you with the knowledge you need to navigate this tricky terrain with confidence. This isn't just about avoiding a penalty, it's about making smart, informed decisions that protect your financial future. So, let's start with the basics. What exactly is Gemini? At its core, Gemini is a cryptocurrency exchange and custodian. Think of it as a financial institution for the digital age. It allows you to buy, sell, and store a wide variety of cryptocurrencies. Founded by the Winklevoss twins, it's known for its focus on security and regulation, which is a big reason why it's a popular choice for many. However, the fact that it's a regulated entity doesn't mean your activity on it is exempt from the law. The CRA is watching, and they have clear guidelines for how they expect you to report your crypto transactions. Now, let's get into the nitty-gritty of Canadian tax law. The first and most crucial concept to understand is the distinction between capital gains and business income. This is the fundamental lens through which the CRA views all of your crypto activities. If your crypto is held for long-term appreciation, and you're not trading it frequently, the CRA will likely classify your profits as a capital gain. This is good news, because only 50% of your capital gain is taxable. For example, if you bought $1,000 worth of Bitcoin on Gemini and sold it for $2,000 a year later, your capital gain is $1,000. Of that $1,000, only $500 is added to your taxable income. This is a powerful tax advantage that can significantly reduce your tax bill. But what if your activity is more frequent? What if you're a day trader, or you're constantly buying and selling different altcoins, trying to capitalize on market fluctuations? In this case, the CRA is more likely to classify your profits as business income. This is a much less favorable outcome, as 100% of your business income is taxable. The CRA looks at a number of factors to make this determination, including the frequency of your trades, the length of your holding periods, your knowledge of the crypto market, and whether your crypto activity is a major source of your income. It's a complex, facts-based analysis, and there's no single rule. The key takeaway here is to be honest with yourself about your level of activity and to be prepared to justify your classification to the CRA if they ever come calling. With that foundation in place, let's look at some specific Gemini features and how they're treated under Canadian tax law. First, let's talk about the most common transaction, buying and selling crypto. When you buy a cryptocurrency with Canadian dollars, there's no immediate tax event. You're simply acquiring an asset. The tax event occurs when you sell that crypto, or when you trade it for another crypto. Yes, you heard that right. Trading one crypto for another is considered a disposition for tax purposes. For the CRA, it's the same as selling your first crypto for its fair market value in Canadian dollars and then immediately using those proceeds to buy the second crypto. You need to calculate the capital gain or loss on that first crypto you traded. This is a common pitfall for many crypto users, and it's a crucial detail to get right. Next, let's talk about Gemini Earn, their interest-earning program. While Gemini Earn is currently unavailable in many jurisdictions, understanding the tax implications of such a feature is vital for any crypto investor. Any interest or rewards you earn from lending out your crypto are generally considered income. This is a separate category from capital gains or business income. This income is fully taxable in the year it's received. It's important to keep meticulous records of these payments, as they need to be reported separately on your tax return. Then there's the concept of staking. Staking is a way to earn rewards by participating in a proof-of-stake network. On a platform like Gemini, you might be able to stake certain cryptocurrencies. The tax treatment of staking rewards can be a bit more nuanced. The CRA has indicated that, similar to Gemini Earn, staking rewards are generally considered income and are fully taxable at the time they are received. The value of the reward is the fair market value of the crypto at the time you receive it. You'll then have a cost basis in that new crypto. When you eventually sell that staked crypto, any further profit or loss will be a capital gain or loss. It's a two-step process. First, you report the income from the reward, and then you track the capital gain or loss on the eventual sale of that reward. So, how do you actually track all of this? This is where the real work comes in. The CRA requires you to keep detailed records of all your crypto transactions. This means you need to track the date of each transaction, the type of transaction, buy, sell, trade, etc., the quantity of the crypto involved, and the fair market value in Canadian dollars at the time of the transaction. You'll need to know your adjusted cost base, ACB, for each crypto you hold. The ACB is the average cost of all the units of a particular crypto that you own. Every time you buy more, you have to recalculate the average. This is where things get complicated, and this is why a lot of people turn to specialized crypto tax software. These platforms can connect to your Gemini account and automatically track all of your transactions, calculating your capital gains and losses for you. While not a substitute for professional advice, they can be a lifesaver for anyone with a high volume of transactions. Finally, a word on non-residents. If you're a non-resident of Canada but you have a Gemini account, your tax obligations are different. Non-residents are generally only taxed on income earned from Canadian sources. However, the sale of taxable Canadian property, which can include shares in a private company or real estate in Canada, is also taxable. For cryptocurrencies, the situation can be complex and often depends on where the business is carried on. It's an area where professional advice is not just recommended, but essential. With that said, thanks for watching and until next time.